Volatility ETFs are attracting increased attention amid geopolitical tensions, rising oil prices, and inflation fears, which are driving sharp market swings. For traders looking to capitalize on heightened uncertainty, volatility ETFs and ETNs can provide exposure to rapid changes in market sentiment and spikes in the VIX Volatility Index. Markets are under substantial pressure, and the situation could get far worse. That's because the US-Iran conflict is showing no meaningful signs of cooling off, and each new development appears to add another layer of risk. Most recently, oil prices surged back above $108 a barrel. Inflation is ticking higher, yields are spiking, and there are fears that consumers may be pulling back on spending. In fact, there are also growing concerns that consumers could begin reducing spending activity. American consumers have been one of the strongest pillars supporting the economy over the past 2 years. However, persistent inflation, elevated interest rates, and geopolitical uncertainty may weaken consumer confidence. If spending slows meaningfully, economic growth could soften further, increasing fears of a broader stock market correction. Adding to investor anxiety is the possibility that the Federal Reserve may postpone interest rate cuts much longer than expected. According to analysts at Bank of America, the Fed may now need to delay lowering rates until the second half of 2027 due to stubborn inflation pressures. That marks a dramatic shift from earlier expectations for 2 interest rate cuts this year, based on the expectation that Kevin Warsh would steer policymakers toward easing monetary policy. Why volatility ETFs are gaining attention? As uncertainty rises, volatility often increases rapidly, creating both risks and opportunities for traders. While long-term investors may remain defensive, short-term traders are increasingly turning to volatility ETFs to potentially benefit from aggressive market swings. UVXY offers leveraged exposure to market volatility. The ProShares Ultra VIX Short-Term Futures ETF, BATS, UVXY, is structured to deliver 2x the daily performance of the S&P 500 VIX Short-Term Futures Index, making it highly sensitive to spikes in market volatility. Because of its leveraged exposure, UVXY can move aggressively during periods of elevated market fear, making it popular among active traders looking to capitalize on short-term volatility spikes. However, leveraged volatility ETFs can also experience significant downside risk if volatility fades quickly, underscoring the importance of risk management. VXX tracks short-term VIX futures without leverage. Another option is the S&P 500 VIX Short-Term Futures ETN, NSRCA, VXX, which provides exposure to the same underlying volatility index, but without leverage. Because VXX is not leveraged like UVXY, some traders may view it as a slightly less aggressive way to gain exposure to rising market volatility. Should volatility continue to build amid geopolitical tensions and inflation concerns, traders could see a retest of the $40 level. XX, which offers exposure to the same underlying volatility index, but without leverage. Should volatility continue to build, a retest of the $40 level. XY provides direct exposure to VIX futures. The ProShares VIX Short-Term Futures ETF, BATS, VIXI, provides long exposure to short-term VIX futures contracts with a weighted average maturity of approximately 1 month. Like other volatility ETFs, VIXI tends to benefit when fear increases rapidly across the broader market. If economic conditions deteriorate further or geopolitical tensions intensify, the ETF could potentially push back toward the $40 level. Because volatility products can move quickly in both directions, traders should closely monitor positions and use disciplined risk controls. Volatility ETFs can help traders capitalize on market fear. In periods of heightened uncertainty, volatility often becomes both a major risk and a short-term trading opportunity. While long-term investors may choose to remain cautious and focus on portfolio preservation, active traders can use volatility ETFs and ETNs to potentially benefit from rapid market swings tied to inflation fears, geopolitical tensions, and changing Federal Reserve expectations. Funds like UVXY, VXX, and VIXI provide different levels of exposure to rising volatility, allowing traders to choose strategies that align with their risk tolerance and market outlook. As uncertainty continues building across global markets, Volatility ETFs may remain an important area to watch.